In this video, you'll learn about the first step in the 9-step accounting cycle, which is analyzing business transactions. What is the 9-step accounting cycle? The 9-step accounting cycle shown here is the continuous process of recording and presenting accounting information so that business transactions become usable and understandable to those internal and external users who need to make business and financial decisions. The accounting cycle starts with the analysis of business transactions. And we're going to talk about the analysis of business transactions in this chapter and the next one. And quite honestly, that is where accountants spend a lot of time, with the analysis of what happened in the business and how it should be recorded. Of course, some transactions become very routine, whereas others, like merging with another business, don't happen very often. In step 2 of the accounting cycle, we'll write down the transaction in the general journal, and in step 3, post it to the general ledger. Step 4 consists of preparing a worksheet, which is a tool accountants use to ensure that all transactions are correct and balanced, followed in step 5 by the preparation of financial statements. In step 6, accountants journalize and post all adjustments that were entered into the worksheet. And in step 7, we would close the temporary accounts and get them ready for the next period. In step 8, the accountant prepares a post-closing trial balance to double check that all temporary accounts were closed and that the remaining accounts still balance. And then in step 9, we would interpret the financial statements. And then next month, it starts again with the analysis of transactions of business transactions. But what exactly is a business transaction? A business transaction is any financial event that changes the resources of a firm. For example, purchases, sales, payments, and receipt of cash are all business transactions. The accountant analyzes each transaction to decide what information to record and where to record it. And to learn this process at the beginning of our analysis, we will use a simplified version of the fundamental accounting equation: property equals financial interest or obligations. Most students learn best with examples, and one of the easiest ways to learn about analyzing business transactions is by studying the transactions of a service business. So our analysis starts with Eli's Consulting. Eli's Consulting is a service business and provides a wide range of accounting and consulting services. The proprietor of the business is Trayton Eli, who is a CPA and has a master's in accounting. The business also has an office manager, Sergio Sanchez. The office manager has an associate's degree in business and has taken 12 semester hours of accounting. Every month, Eli's Consulting Services bills clients for the accounting and consulting services provided that month. And customers can pay in cash when the services are rendered or receive credit. But you'll learn more about that later. So to start the business, Trayton took money from his personal checking account of $100,000 and opened a checking account in the name of Eli's Consulting Services. So why do you think Trayton opened a new checking account? Well, the separate bank account helps Eli keep his financial interest in the business separate from his personal funds. The $100,000 transaction is the very first business transaction, and we need to figure out what to do with it and identify how it affects the equation property equals financial interest. Aside from the $100,000 business transaction, there are other business transactions for Eli's Consulting, and in all we have 12 transactions to analyze. Small businesses may only have a few transactions in a day, whereas larger businesses have thousands or even tens of thousands of transactions in a day. I won't read each transaction now, but we'll cover each one of them in this video and the second part of analyzing business transactions. Before analyzing these 12 transactions, though, let's talk about the simplified equation I mentioned before. Property equals financial interest or obligation. Every business transaction involves at least two parts. Later, we will call that a debit and a credit, but for now, we'll only talk about increases and decreases. Property includes things like cash, monies owed by customers, called accounts receivable, equipment, office supplies, building, land, expenses paid in advance, called prepaid expenses, and inventory. In short, these are monies that the company owns. Financial interests and obligations are monies owed by the business, such as monies owed to supplier, called accounts payable, bank loans, notes payable from supplies, monies received in advance from customers, and monies owed to the owner of the business. A transaction might impact both the property and the financial interest, meaning that both sides increase or decrease. Another transaction might increase one property category and decrease another property category. Or yet another transaction might increase one financial interest category and decrease another financial interest category. But after every transaction, though, the equation must still be true. Property equals financial interest. We'll now look at the first business transactions for Eli's Consulting. There are two major steps to analyzing the business transactions. We first describe the financial event by identifying the property, which in our case is that the business received $100,000 in the form of cash. Then we identify who owns the property, who has the financial interest. And for this transaction, Eli has a $100,000 financial interest in the business. And next, we determine the amount of the increase or decrease. The business now has $100,000 more cash, and Eli now has a $100,000 interest in the business. That means that property increased and the financial interest or obligation increased as well. So let's enter the transaction into our table and calculate the new balance. The second step is to make sure the equation is still in balance, which in this case it is. After this first transaction, $100,000 in property equals $100,000 in financial interest. In this second business transaction, Eli's Consulting Services issued a $5,000 check to purchase a computer and other equipment. So let's analyze it. The firm purchased new property, which is equipment, which means that the property increased. The firm also paid out $5,000 in cash, which means that property decreased. We'll add another category for equipment on the property side and write plus $5,000 into the equipment column and write minus $5,000 in the cash column. Does our equation still balance? Yes, it does. For our third transaction, we'll analyze the following transaction. Eli's Consulting Services purchased office equipment on account from Office Plus for $6,000. Buying on account means that you don't pay the full amount right now. However, we have to keep track of the amount owed and the equipment purchased. The firm purchased new property, equipment, for $6,000, which means that property increased. Eli's Consulting owes $6,000 to Office Plus, which means that the financial interest obligations also increased. We'll add another category for accounts payable on the financial interest side and write plus $6,000 into the accounts payable column, and then write plus $6,000 into the equipment column. Does our equation still balance? Yes, it does. These activities are recorded for the business entity Eli's Consulting Services. Trade in Eli's personal assets, such as his personal bank account, house, furniture, and automobile, are kept separate from the property of the firm. Non-business property is not included in the accounting records of the business entity. Here's the fourth transaction. Sanchez purchased supplies so that Eli's Consulting Services could start operations. The company that sold the items requires cash payments from companies that have been in business less than 6 months. Eli's Consulting Services issued a check for $1,500 to Office Deluxe to purchase office supplies. So what happened here? The company's cash decreased, and the company increased supplies on hand. So let's write that into our table. We'll add an additional column for supplies and add $1,500, and we'll subtract $1,500 from cash. The new cash balance is now $93,500, and when we add up all property accounts, cash, supplies, and equipment, the sum is $106,000, which is the same amount as for the financial interest accounts. Therefore, our accounting equation still holds true. So let's now look at the fifth transaction. The office manager Sanchez pays $2,500 to Office Plus to reduce the firm's debt. This related to our third transaction when Eli's Consulting bought computer equipment on account from Office Plus for $6,000. When we analyzed that original transaction, we increased computer equipment and we increased accounts payable. Now that Sanchez pays part of the $6,000 that Eli's Consulting owes Office Plus, we need to reduce the accounts payable account, but we also need to reduce the cash. So we deduct $2,500 from cash, and we deduct $2,500 from accounts payable. The sixth transaction is about Eli's Consulting renting offices. In November, the office manager Sanchez arranged to rent facilities for $4,000 per month, beginning in December. The landlord required that rent for the first 2 months, for December and January, be paid in advance. The firm prepaid, meaning paid in advance, the rent for 2 months. In accounting, this right is considered a form of property because the business could get a refund potentially if it did not use the facilities for the entire time. Eli's Consulting Services issued a check for $8,000 to pay for the rent for the month of December and January. So what do we need to do for this transaction? We need to add an additional account called prepaid rent to the property side of our equation and add $8,000. We need to also reduce cash by $8,000. Why is the rent payment not an expense? Well, the payments for expenses are not actually recorded as an expense until such time that the company incurs the expense. That means we can't recognize the rent for December of $4,000 until we close the books for the month of December. Until such time, it is considered property of the company. We'll learn more about that, though, about such transactions like prepaid expenses and accrued expenses later. The table we've been using provides us with a lot of information already, such as how much cash is available, how much the company owns in terms of supplies, prepaid rent and equipment, and how much the company owes to others. Another way is to use this information is to prepare financial statements that external and internal users can readily understand. Why not use this table for external and internal users? Well, a standardized format is much easier to understand and compare. So we prepare our first financial statement, the balance sheet, by listing all property accounts as assets. And on the other side of the balance sheet, we list the financial interest accounts, such as liabilities, if money is owed to vendors or other creditors, and we list the money owed to the owners under owner's equity. The balance sheet shows the firm's financial position on a given date. In our example, it's November 30th, 2021. And the fundamental accounting equation, also called the balance sheet equation, represents the relationship between the assets, liabilities, and owner's equity of a business. The fundamental accounting equation states that assets equals liabilities plus owner's equity or stockholders' equity. And another way to state it would be to say when we subtract all liabilities from the assets, we find the owner's equity or net worth of the business. That's it for this part. Please see the second part of analyzing business transactions to learn how to analyze the remaining business transactions for Eli's Consulting.